Hey guys, Taylor with GammaEdge here, coming at you with a market recap for April 2nd, 2025. Another strong day for the bulls. Able to climb back from that gap down, close above prior day high, and see after market's a bit newsy with the tariff announcement. But let's get into the pre-market prep today, see how you could have taken advantage of today's price action. So here, as we always do, starting out with our market trend model. Again, this is based off the tick index. If you're not familiar with the tick index, it simply just measures upticks versus downticks in the market. Go to Investopedia if you want to learn more about that. So what we do is we take the raw unfiltered tick day over day, which it resets, and we create something called the cumulative tick, which is a time series. So we can understand the day over day, multi-day, multi-week trends of the tick itself, which obviously gets lost in just the daily tick that resets. Additionally, we create something called the filter tick, which is this bolded cyan line. This measures plus or minus 1,000 tick readings, which the market accepts as a general benchmark for a significant buying and selling. So reason that's important is last week we were seeing major selling. Monday we saw a little bit of buying into the afternoon. Tuesday saw a little bit more buying. The cumulative tick itself has started to trend higher modestly at best. So that tells us in the very immediate term, the momentum in the market has shifted a little bit. Although keep in mind, the longer term trends are still lower. So what that means is the bulls are guilty until proven innocent. So we need to see a significant ramp and continuation higher, a lot of significant buying coming into the market before we get more confident that it's a better swing trader environment from the long side. So the market trend model is great at giving us context on just general price momentum. From there, what we do next to understand the environment as well is we look at the SPX options complex. Reason for that is A, SPX options complex is forward-looking by nature. B, SPX options complex is the largest, most liquid options market in the world. And this gives us good insight into how speculators are positioned and what they're expecting in the future. Now, keep in mind the SPX is broken into two components. There's the SPX-A and the SPX-P. SPX-A, think of it as a cruise ship. This is where your longer-term kind of institutional money is, and it's much larger than the SPX-P, which you can think of as a cigarette boat. That is more where the short-term speculators like to participate. Those contracts turn over rapidly day over day. That's where your 0DTE is focused. That's where your daily and weekly expirations are as well. But starting with the SPX-A, which again is your monthly and your quarterly expirations, we can see that we started in a put-dominated environment. This has been a general theme for quite a while now is, the longer-term SPX-A has just been a put-dominated environment. And we know that a call-dominated environment is much more conducive to kind of a bullish foundation where we expect price appreciation to the upside, which clearly you can just think of this as the foundation of the market is not stable right now. And just so you can see an example to compare it to, here is a previous example of SPX structure where it was a call-dominated environment. Obviously, it's a completely different characteristic. We have green everywhere, again, call dominated above the spot price. Remember that it's our belief markets are driven by out of the money call and put speculation. So here, there's clear call speculation to the upside. And then again, compare this to SPX-A. There is, really no call speculation to the upside. It's dominated by puts. So yes, the market can go higher, right? Like the market trend model is trending higher. However, for us to get more of a belief that a multi-week, multi-month rally is to start, then we need to see this structure materially change for those call speculators coming in. And then here's the SPXP. Again, a little bit smaller complex. This is where your short-term speculators like to transact. The way it generally goes is the SPXP is going to shift before SPXA. That just makes sense given the nature of the trader, right? Those short-term speculators are able to change course a lot faster than the longer-term capital, hence the cigarette boat versus the cruise ship analogy. So again, here, net, it is a put-dominated environment. I will note that day over day, it became less put-dominated. However, nonetheless, it still is a put-dominated environment, but it is at least good to see in the short term that the market trend model is trending higher, starting to trend higher. The SPXP complex, as we think about it like a sine wave, from day over day, that indicates that we have at least hit a bottom and we're now trying to come up that sine wave into a call-dominated environment. So that's where it's important to track this stuff day over day to see if the ice is thawing. And again, that would look like this becomes more call-dominated, built out overhead, and the market trend model continues to progress higher. Additionally, what we can see here is our transition zone, focusing on the DEX or the Delta transition zone with the full complex. Key level there is 5635. Yes, we had a node down here at 5605, 5635, then 5600. Those are key levels in the sand. So bulls, you really want to see this 5635 level taken out to the upside. So now that we understand A, the market trend model, B, then in the context, the SPX A and the SPXP, all expirations are turned on. Let's get into the SPX 0DT, right? Because that's its own beast. This is just kind of an intraday view of what we let go as opposed to what the other conditions are. Now keep in mind, those other conditions are important. Just understanding, if there's a weight being pushed down in the market, being put speculation, or if it's being kind of lifted up with call speculation, and then also which way is the market trend model moving to, right? Because if it's moving higher, ideally that's moving higher intraday, then that should be constructive for SPX 0DT trading, making sure we're above our key levels and then trading in line with the trend as well. But do keep in mind, 46% of daily volume takes place on SPXP. So, despite the overall structures of SPXA, SPXP, the full complex, SPX 0DT on its own intraday basis is going to do what it's going to do. So it is possible where, the overall environment is bearish, but the setup on the day with SPX 0DT is bullish and vice versa. So that is why we kind of separate these analysis, and 0DT is really its own beast. So with all that to say, looking at the complex now, we do the exact same analysis, right? It's fractal in the nature, meaning what works on one instrument works on another, one time frame works on another time frame. So first starting out, put dominated above spot price, call dominated below spot price. This is the general setup that's not crazy to see. Next, this is where our transition levels come in. So we know above what levels we should be more bullish and below what levels we should be more bearish, and then what levels in between we should expect choppy price action. So that choppy price action, that's going to be implied with our DEX transition zone, which is based off delta in the distribution of calls and puts in the 0DT complex. This is from 5625 down to 5600. So within this zone, we expect to see choppy price action. Above 5625, we see more of a path higher. Below 5600, we see more of a path lower. Now keep in mind, the path higher and the path lower, we want to see the market trend model and our intraday volume analysis confirm this move, and we will get to the intraday volume analysis here in a minute. But I just want to say how, it's a mosaic approach, right? We have just a couple tools. We don't have a ton of tools. We're not a kitchen sink. We just have a couple key tools that we want to see confluence between, and that gives us a lot more confidence to the long, short, or choppy sides. So after the DEX transition zone, we also focus on something that we call the drunken sailor range. Again, this is based off the distributions of calls and puts in the complex. And you can think of this as, above the DEX transition zone, but in between the drunken sailor zone. We are in a call dominated environment, but it's a weak call dominated environment, meaning that calls are not overly aggressive in this area. So this is where your intraday volume is going to still be able to push price around, as opposed to the natural kind of dealer market maker mechanics and the moneyness of in the money versus out of the money options, right? So again, within this area, well, really the entire day is driven by, intraday volume, right? Because delta, being the first order Greek, is really impacted by the opening and closing of transaction, but it's specifically important when we're in really this area of the structure. So that's the reason that we specifically note it. And so just coming down here, was implying that the market open was around 55.75. So from down here, obviously we're below the transition zone, but we are never ones to short in the hole, right? Like we want to see our intraday volume analysis confirm that move lower, or the recovery and the move higher. And so the path of it being higher is we break through, we break through the DEX transition zone. Okay, that's great. Now we're in a call diamond environment. We want to see intraday volume move higher, and then we push above the drunken sailor range. And then to the downside, it's perfectly rational if we come back into the drunken sailor zone, and then typically what we see there is a reversal lower. We see our intraday volume, put speculation really ramp to the downside. And then we break through the bottom of the drunken sailor zone, and would be remiss to say that we would also see filter tick buying to the upside, or filter tick selling to the downside. So right, just to recap the pre-market prep real quick, very simple. There's just a few tools on our tool set. Well, we have a lot of tools, but we just try to boil it down to a few key ones intraday. That being the market trend model, understanding where our key levels and transition zones are at, and then what intraday volume is doing. So let's now get into what the day had for us. right, we have our transition zones drawn. The teal box is our drunken sailor range, and the purple box is our DEX transition zone. Just right off the bat, you can see the utility of the drunken sailor range. We had a ton of price interaction with that today. But anyways, what we did, we had obviously the gap down. Did not see any further price movement to the downside. Unable to break through the bottom of the drunken sailor range again. Then we started having this choppy back and forth action within the DEX transition zone, and really a lot of interaction with the top of the DEX transition zone. And so once we were able to break through the top of the DEX transition zone, that's where we started to see momentum pick up to the upside in the market. And then right above, then we, interacting with the top of the DEX transition zone, and then, it would get a pretty good push higher as well. Again, we got almost up to 5,700, which is a key psychological level. So that was a natural place for at least some type of profit, some type of monetization event. But nonetheless, even if you're just trading levels to levels, you should see the importance of the transition zone, right? Like we had clear interaction here with the top of the DEX transition zone, clear interaction with the top of the drunken sailor zone. So, there's plenty of good trade opportunities from the top of DEX transition to the top of the drunken sailor range. And then, right, as we're kind of unable to really break away from the drunken sailor range, that's where your credit spread trading could come into play. But here, when I talk about intraday volume analysis, this is kind of the key chart that most people in the community use. What we're doing simply here is we're measuring the call and put volume on the SPX 0DT contract. And more specifically, what we're doing is on a 5-minute basis, we are aggregating the call and the put volume. We are finding the middle of that distribution, which we call a centroid, and we're plotting that point on those 5-minute intervals throughout the day. Then we are connecting those lines. And that gives us an understanding of how those speculators above those call and put speculators are behaving. Because what we see is, when we get a move higher, a sustained move higher intraday, we see call speculation, put speculation ramping, choppy price action, sideways, downward price action. We see that put speculation confirm that move down, call speculation moving lower as well. So the key thing to note here is, yes, we got that initial gap down, but we saw put volume ramping higher, call volume was ramping higher all throughout the early morning session. And here's the market trend model, and this was confirmed with the market trend model, right? We had a pretty decent linear update today, which is just a fancy way of saying we just had a nice continuation day, settle buying throughout the session, confirmed with filtered tick buying as well. So that gave us confidence that, yes, we were getting that push higher with price action moving through those key levels, and the actual buying under the hood of the market was confirming that as well. So going back to this tool, it would have been, completely normal just looking at this tool in a vacuum to expect, once we did get that reversal, for buying to continue. The reason being is because we were seeing a ramp higher in that call speculation. However, one thing to keep in mind that we hit on in the pre-market prep was up here at 5,700 in the structure. That's what we call COI, which was the strike with the most call open interest. So a way to think about this, that's kind of a natural monetization level, or kind of an upside target level. The reason being is, just think about it. These speculators were way out of the money, and now at 5,700, they're at the money. So they have had significant price appreciation in those contracts. So kind of locking in that money tends to make sense. Now, if that's the reason that we sold off from 5,700 or not, no idea. However, that's just kind of a thought process and a way of managing your risk. So, if you took a trade off the top of the drunken sailor range as an example, 5,700 was a natural target for you. However, having said that, once we did reverse off 5,700, then it was clear that there was really not going to be any type of move higher, retest higher for the rest of the session. Reason being is we just did not see any call speculation pushing higher with a signature that looked like this. I mean, that was the exact opposite signature. So, if you're a credit seller at this time, selling above and below the centroids makes a lot of sense there. Or even, if you're going back to a credit seller with a signature like this one, we were getting up moves all day, selling below the centroids or something like that, selling put credit spreads tended to make sense as well. Obviously, didn't want to do it, right when we were at 5,700, because there is the reverse of a reversal there. So yeah, hopefully that makes sense on how we use, intraday volume in the context of trading SPX and kind of intraday price moves. Now you can go back and you can watch, yesterday and the day before, where we had choppy days. We had linear up days as well. So you can see the signature of those volume charts as well and how we utilize that in the context with our key levels. And so last thing is, where do we go from here? So the market trend model continues to improve day over day. We want to see this obviously continue higher. We want to see that filtered tick buying come in, telling us that large players are stepping into the market. And then most importantly, we want to see those SPX P and SPXA full complex dashboards thaw out and start to become call dominated. That tells us, right, that we're moving up the sine wave. Here's SPXA again. We're moving up the sine wave. Those put speculators no longer interested in having their positions on. Those call speculators are starting to pile back in with the expectation of higher moves. So with that, you all have a great night, and we will see you tomorrow. Thanks. Bye.